All right, let's jump right into this explainer. Today, we're going to trace exactly how a single, localized geopolitical rupture in the Middle East ends up sending massive shockwaves through global energy markets, international finance, and domestic supply chains. We are looking at a choke point failure that a lot of folks thought was just a low probability outlier, but as you'll see, it's rapidly becoming our new reality.
Here's how we're breaking it down today. First up, the 2026 Hormuz Blockade. Second, we'll cover global energy and safe havens. Third, we zoom in on India's economic squeeze. Fourth, we'll unpack the fertilizer LNG paradox. And finally, we'll look at the new energy sovereignty era.
Okay, part one, the 2026 Hormuz Blockade, the inciting incident at the world's most critical choke point.
Look at how terrifyingly fast diplomacy can just completely collapse. On February 28th, nearly 900 precision strikes hit critical infrastructure in the span of just 12 hours. By the very next day, the Strait of Hormuz is effectively closed to all tanker traffic. And then, by March 9th, we see a full maximum asymmetric retaliation kicking in, using sea mines and drone swarms. Literally, in barely over a week, the world's absolute most critical maritime choke point is fully weaponized. 20 million. That is a massive number. We're talking 20 million barrels of crude oil a day, just instantly wiped off the global market. To put that into perspective, this physical bottleneck also removes about 20% of the world's liquefied natural gas supply right along with it. And look, even with the International Energy Agency jumping in to coordinate an emergency release of 400 million barrels from reserves, you're still looking at a massive daily shortfall. The global economy just absolutely does not have the structural redundancy built in to absorb a total stoppage at a node this critical. Now, check out this geopolitical risk premium. It's basically acting as a structural floor right now. It's keeping Brent crude artificially elevated at around $120 a barrel. And here's the thing. This premium isn't just your standard temporary price spike anymore. It's the market literally pricing in the permanent terror of choke point blockades. Even if a little bit of supply manages to sneak through, the sheer fear of the situation maintains this $25 to $30 surcharge.
Moving on to part two, global energy and safe havens. Let's track that flight of capital.
You know, a lot of folks immediately compare this to the 1973 oil embargo, but let me tell you, today's high-tech siege is just a totally different beast. Back in 73, it was a political embargo, and the world was 80% dependent on oil. Today, sure, we're slightly less fossil dependent at about 60%, but the disruption is kinetic, and it's directly targeting highly digitized supply chains. So a disruption today doesn't just mean waiting in a long line at the gas station. It cascades through power grids and logistics networks in milliseconds. So what happens when global panic sets in? Capital runs for safety. This triggers what we call the demand factor, or the convenience yield. During severe geopolitical stress like this, investors will actually forfeit higher returns elsewhere just to park their money in the ultimate safe haven, long-term U.S. Treasury bonds. They want peace of mind so badly that they'll happily accept a much lower interest rate just to get it. And when you visualize this demand factor, it's pretty striking. Notice how it absolutely plunges down into negative territory during periods of severe market distress. In term structure models, this perfectly captures that intense global flight to safety. Investors are basically paying a premium just to be able to sleep at night. Okay, part three, India's economic squeeze. This is what we call the macro double whammy. India finds itself in an incredibly vulnerable spot here. The country imports roughly half of its liquefied natural gas straight from Qatar and the UAE. So with Hormuz closed, those absolutely vital energy shipments are paralyzed. The government is instantly forced into crisis mode. They literally have to invoke the Essential Commodities Act just to ensure everyday families have kitchen gas, all while heavily restricting the supply to industrial users. And here is the immediate fallout. The Indian rupee breaches 92 to the US dollar. Talk about a painful double whammy, right? First, your oil prices are skyrocketing globally. But second, because billions of dollars are fleeing emerging markets to buy up those safe US treasuries, the local currency that you actually use to buy that expensive oil just collapses. A weaker rupee automatically makes every single barrel 10% more expensive for local refineries right off the bat. Now, this squeeze doesn't hit everyone equally. Your frontline casualties are aviation, city gas, and, super importantly, fertilizers. These are sectors that rely heavily on direct fuel margins or natural gas. But don't be fooled, the pain trickles down fast. Moderately impacted sectors like consumer goods, ceramics, and automobiles get hit almost immediately with cascading freight costs and a sudden, sharp drop in consumer demand.
Which brings us to part 4, the fertilizer LNG paradox. This is the unseen agricultural crisis. Watch how incredibly fast this domino falls. Step 1, the blockade halts LNG from massive facilities like Qatar's Ras Laffan. Step 2, suddenly gas is scarce, so governments are forced to cap allocations to fertilizer plants at just 70%. Step 3, that restriction completely paralyzes the production of urea. And step 4, fertilizer costs spike 35% right at the start of Asia's critical sowing season. It's crazy. An oil blockade transforms into an agricultural crisis almost overnight. But it's not just fertilizers. The physical blockade itself has completely shattered traditional trade pipelines. The main Surat-Dubai trade link? Severed. Agricultural trade across the board has shifted to force majeure. This means those uninsurable shipping routes have left things like Indian basmati rice exports completely paralyzed. And perishable goods, think apples imported from Iran or Indian bananas meant for the Gulf, are quite literally sitting there rotting at the ports. The energy weapon has gone multi-scalar. It's hitting the global food supply chain directly.
Finally, part 5, the energy sovereignty era. Say goodbye to just-in-time logistics.
So nations are really waking up to the fact that just-in-time efficiency was kind of like driving your car on fumes just to save weight. It works brilliantly right up until you hit traffic. It's way too fragile for this new reality. Instead, we're seeing a massive pivot globally toward energy sovereignty. Basic security is now trumping climate sustainability. You actually have states reopening coal plants just to guarantee baseline power. They're also fast-tracking alternative land-based routes, like the India-Middle East-Europe Economic Corridor, just to bypass these maritime straits entirely. When you look at the vast economic and agricultural fallout of the Hormuz blockade, it really proves one thing. A disruption thousands of miles away dictates the price of food on your table and the value of the currency in your bank account. And that leaves us with an urgent question to ponder. As this era of hyperglobalization fractures, what extreme measures will your country take next to guarantee its own survival in this new age of energy realism?